Dubai, $127 per ounce. New York COMEX, $73. Same metal, same day, 74% gap. This isn't a pricing error. Fortune 500 manufacturers are chartering private cargo flights. Emergency procurement teams deployed across 3 continents, some paying $50 premiums over spot just to secure physical delivery. 28 million ounces left in COMEX vaults. Against contractual obligations exceeding 300 million, China controls 70% of refined supply, and the export window just closed. The mathematics here don't resolve peacefully. What comes next isn't speculation anymore. It's already in motion. Welcome to Daily Silver Crisis. If you've built something in your career, if you understand that markets don't warn twice, you're in the right place. We'd appreciate if you'd subscribe, not for algorithms, but because what unfolds in precious metals over the next 6 months will rewrite supply chains you've spent decades building. And before we go further, drop a comment. Where are you watching from today? New York? Texas? Perhaps London or Dubai, where these price gaps are playing out in real time? Your location matters, because what you're paying for silver right now depends entirely on which market you're standing in. Let's examine why that's happening. On January 14, 2026, a metals trader in Dubai refreshed his screen 3 times before calling his supervisor. The number didn't make sense. Physical silver bars sitting in a vault 12 kilometers from his office were trading at $127 per ounce. He pulled up the New York COMEX futures contract at $73. Same metal, same purity, same day, a 74% gap. His supervisor made 2 phone calls, the first to their London office, the second to their legal team. By Wuho, 3 o'clock Dubai time, the company had placed the largest physical silver order in its 40-year history. They weren't alone. Across trading desks in Singapore, Zurich, and Hong Kong, procurement managers were seeing the same impossible math. And they were all reaching the same conclusion. Something fundamental had broken in the silver market. This wasn't normal volatility. In 2008, during the financial crisis, physical silver traded at a 12% premium over paper contracts. Unusual, but explainable. In 2020, when COVID shutdowns disrupted supply chains, that premium reached 35%. Painful for manufacturers, but temporary. 74% wasn't a premium anymore. It was a completely separate market. The question nobody wanted to ask out loud: which price was real? The paper contract that said 73, or the physical metal that cost 127? The answer was becoming clear. Because when manufacturers needed actual silver, for circuit boards, for solar panels, for medical equipment, they couldn't use a paper contract. They needed metal, and metal had a very different price. 3 weeks earlier, on December 22, 2025, China's Ministry of Commerce had published a 73-word announcement. Most financial news outlets ran a 2-sentence summary and moved on. That announcement restricted exports of refined silver. It seemed minor, technical, the kind of regulatory update that gets filed away and forgotten. But that 73-word announcement controlled 70% of the world's refined silver supply. Read that again. 70%. Not iron, not aluminum, not copper, where substitutes exist and alternative suppliers can scale up production. Silver, the metal that conducts electricity better than any other element. The metal that kills bacteria on contact. The metal that reflects 95% of light in solar panels. The metal with no substitute in thousands of industrial applications. And China had just restricted 70% of global supply. A commodities analyst in Boston pulled historical data going back 30 years. He wanted to see if anything comparable had happened before. He found nothing. Tin in the 1980s came close. Rare earth elements in 2010 created similar dynamics, but those markets were smaller, less critical, less woven into every major manufacturing sector. Silver was different. The global economy consumed 520 million ounces every year. Electronics manufacturing alone required 240 million ounces. Smartphones, computers, electric vehicle components, data centers, solar panel production needed 130 million ounces, and that number was growing 18% annually as countries pushed renewable energy mandates. Medical and pharmaceutical applications used 65 million ounces. Antibacterial wound dressings, diagnostic equipment, surgical instruments, defense and aerospace consumed 45 million ounces, missile guidance systems, radar technology, satellite components. Total annual production? 780 million ounces. The math had always been tight. A 260 million ounce annual surplus. Enough buffer to handle disruptions. But that surplus assumed normal supply chains. Normal meant Chinese refineries processing raw ore and shipping finished product to manufacturers worldwide. Normal meant COMEX warehouses in New York holding adequate inventory to back futures contracts. Normal meant price arbitrage working. When silver cost more in Dubai, traders would ship metal from New York until prices balanced. None of that was normal anymore. A supply chain manager at a Fortune 500 electronics manufacturer received an email from her primary silver supplier on January 9th. Unable to guarantee delivery on Q1 contracts. Recommend immediate spot market procurement. She checked their inventory. 60 days of supply. Standard practice. They'd operated on 60-day cycles for 12 years without issues. She made 3 calls to alternative suppliers. Same message. All 3. By January 11th, she had authorization to purchase 6 months of inventory at any price. She wasn't the only one. Across the manufacturing sector, procurement teams were abandoning 12 years of just-in-time inventory optimization, the efficiency gains that had boosted profit margins, the lean operations that eliminated wasteful stockpiling, all of it reversed in 72 hours, because efficiency only works when supply is guaranteed, and supply was no longer guaranteed. The COMEX warehouse data told the story in numbers. 2023, 84 million ounces of registered silver available for delivery. 2024, 56 million ounces. January 2026, 28 million ounces, against open interest, contractual obligations for physical delivery exceeding 300 million ounces, a ratio that had always existed. Paper contracts always exceeded physical inventory. That was how futures markets worked, but the ratio had limits, and those limits had just been breached. When the metals trader in Dubai saw $127 on his screen, he was seeing the market's answer to a simple question. How much would someone pay for metal they absolutely needed when paper promises were no longer enough? The 80% surge wasn't speculation. It was mathematics catching up with reality. On January 16th, a senior buyer at a California solar panel manufacturer did something he'd never done in 23 years. He booked a same-day flight to Singapore, not for a conference, not for supplier negotiations, not for factory inspections, to personally escort 4,000 ounces of silver on a commercial flight back to the United States. 4,000 ounces, roughly 250 pounds, worth approximately $500,000 at current spot prices. His company's legal team had reviewed the plan. Security consultants were hired, insurance policies written, 3 seats purchased on Singapore Airlines, 1 for him, 2 for the locked cases. This was a Fortune 100 company with established supply chains, long-term contracts, and banking relationships spanning 4 decades, and they were hand-carrying metal across the Pacific like it was 1823 because the alternative was shutting down production lines in 11 days. The scramble had begun. Across the electronics sector, similar scenes were playing out. A procurement manager in Austin called 7 different suppliers in one morning. 5 couldn't commit to delivery dates. 2 quoted prices $48 above the COMEX future settlement. $48 per ounce premium. She ran the calculation. Their standard order, 12,000 ounces quarterly, would now cost an additional $576,000, just for the privilege of receiving actual metal instead of a contractual promise. Her CFO approved it in 14 minutes, because the math on shutting down production was worse. Much worse. A smartphone manufacturing line that goes dark costs approximately $1.2 million per day in lost revenue. Parts spoilage, labor inefficiency, contractual penalties to retailers expecting inventory. Paying a $48 premium was cheap insurance. But it revealed something deeper. The futures market. The paper contracts that were supposed to provide price certainty and hedging protection had stopped working. A derivatives trader in London explained it to his client this way. Your contract says you can buy silver in March at $78 per ounce. Congratulations. You have a legal right to a price. What you don't have is a guaranteed right to physical delivery. If the counterparty can't source metal, they'll cash settle. You'll receive the contract value difference. But you won't receive silver. The client went quiet. So the hedge doesn't actually hedge supply risk? Not anymore. Not in this environment. The solar industry was hit even harder. A developer in Arizona had financing approved for a 600 megawatt installation. Panels ordered. Grid connection secured, tax incentives confirmed, construction crews scheduled. Then the silver supplier sent the revision. Input costs had increased 63%. The panel manufacturer was passing through the increase. Take it or delay the project 18 months while they sourced alternative supply. The developer ran new numbers. At the revised pricing, the project's internal rate of return dropped below the threshold required by their lenders. The financing package collapsed. 270 jobs disappeared. A rural community lost projected tax revenue because of silver. One element. One supply chain input. 63% cost increase. The project wasn't canceled. It was mathematically impossible. Medical device manufacturers faced a different problem. They couldn't just delay. FDA regulations required specific antimicrobial properties in certain surgical instruments and wound care products. Silver was the only approved material for those applications. A company in Massachusetts produced specialized catheters. Silver-coated to prevent infection, they supplied hospitals across the Northeast. Their supplier called January 12th. We can fulfill 40% of your order. The rest, we don't have allocation. 40%. The procurement director asked the obvious question. What do we tell hospitals? Silence on the line. Then, I don't know. We've never been in this situation. Neither had the hospitals. Recycling facilities became unexpected players. A precious metals recycler in New Jersey received 16 calls in 1 week from manufacturers asking about reclaimed silver from electronic waste. 16 calls? They normally received 2 per month. The facility manager explained the constraints. Processing capacity was fixed. It took 6 weeks to extract and refine silver from circuit boards. Current backlog was 11 weeks, and even at maximum output, they could only produce 8,000 ounces monthly. One manufacturer needed 30,000 ounces quarterly. The math didn't work. Alternative sourcing wasn't solving the problem. It was revealing how deep the problem went. Meanwhile, a quieter movement was happening. Corporate treasury departments were reclassifying silver inventory on balance sheets. What had been categorized as raw materials was being moved to strategic assets. The accounting change seemed technical, but it meant something specific. Strategic assets get different treatment. Higher insurance, secured storage, executive-level monitoring. Companies were treating silver the way they treated proprietary technology, because in this environment, it had become just as critical and just as difficult to replace. A risk management consultant in Chicago started receiving unusual requests. Can you help us model supply chain failure scenarios if silver availability drops another 30%? Not price scenarios, availability scenarios. His clients weren't asking what happens if silver hits $150. They were asking what happens if silver hits $150 and you still can't buy it. That question didn't have a comfortable answer, because embedded in that question was a deeper reality. The scramble wasn't about price anymore. It was about access, and access was becoming the scarcest commodity of all. A compliance officer at a major New York bank pulled trading records at 6:47 a.m. on January 18th. His screen showed something that made him forward the file to 3 separate departments before his coffee finished brewing. Silver derivative positions, institutional short exposure, concentrated across 4 banking entities. $180 billion. He read the number twice. $180 billion in notional value tied to silver prices staying low, or at minimum, staying predictable. Silver was currently neither. The positions had been built over years. Hedging strategies, market-making obligations, proprietary trading desks convinced that industrial metal supplies were stable, and Chinese export policy was reliable. Both assumptions were now outdated. And derivatives don't care about assumptions, they care about settlement dates. A former COMEX floor trader explained the mechanism to a colleague over lunch in Manhattan. Think of it this way. The contract says I owe you 1,000 ounces of silver in March at $82. That's the agreement. But registered COMEX inventory, the actual metal available for delivery, is 28 million ounces. Open interest, 300 million ounces in contractual claims. He paused while the waiter refilled water glasses. Now do the math. If even 15% of contract holders demand physical delivery instead of cash settlement, where does the metal come from? His colleague understood immediately. It doesn't. Exactly. So what happens? The question hung in the air. What happens when contractual obligations exceed physical supply by 10-to-1 ratios? When the paper market promises delivery that the physical market cannot fulfill? History provided some answers, none of them pleasant. In 1980, the Hunt brothers attempted to corner the silver market. Prices spiked to $50. COMEX changed the rules mid-game. Margin requirements increased. Liquidation-only trading imposed. The position collapsed. In 2008, multiple commodities faced delivery squeezes, regulators intervened, cash settlements forced, legal disputes lasted years. But this situation had a critical difference. The Hunt brothers were speculators trying to manipulate price. This was industrial manufacturers trying to secure supply for actual production. You can't regulate away legitimate demand. A risk analyst in Washington, D.C. was modeling scenarios for a government agency that preferred not to be named. Scenario 1. Prices stabilize at current levels. Physical premiums gradually compress. Chinese export restrictions ease by Q3. Market stress resolves over 12 months. Probability, 18%. Scenario 2, two-tier market becomes permanent. Paper contracts settle at one price. Physical metal trades at sustained premium. Industrial allocation systems develop. Manufacturing sectors adapt over 24 months. Probability, 47%. Scenario 3, major contract default. COMEX fails to deliver on significant percentage of March contracts. Regulatory emergency measures. price spike above $150, congressional hearings, permanent structural change to futures markets, probability 35%. She submitted the report on January 20th. Her supervisor read it twice, then scheduled a classified briefing, because Scenario 3 had implications beyond silver markets. If COMEX couldn't guarantee delivery on silver contracts, what did that mean for copper, for gold, for platinum, for every commodity future traded on the exchange? Confidence in paper contracts was the foundation of modern commodity markets, and confidence was becoming negotiable. Meanwhile, the margin requirement changes were creating forced liquidations. A hedge fund in Connecticut had established a silver position in October, moderate leverage, standard risk parameters, well within their mandate. On January 14th, COMEX increased margin requirements from 12% to 22%. On January 17th to 35%. Their position required an additional $9.3 million in collateral. They didn't have $9.3 million in liquid reserves allocated to this trade, so they liquidated, sold at $79, a price they believed was temporary panic, a price that would reverse once cooler heads prevailed. 5 days later, silver was trading at $94 in spot markets. Their risk manager did the calculation. If they'd held the position, the fund would have made $12.7 million. Instead, they'd lost $2.1 million. But that wasn't the painful part. The painful part was understanding why the margin requirements had increased. Officially, it was standard risk management. Volatility had increased. Margin requirements adjusted accordingly. But the timing seemed precise. Increase requirements during a price surge. Force leveraged longs to liquidate. Create selling pressure. Suppress price temporarily. Benefit those holding short positions. Was it manipulation or prudent risk management during extraordinary volatility? The question depended entirely on who you asked and whether you'd been forced to liquidate. A derivatives attorney in Chicago reviewed the legal framework. COMEX had broad authority to adjust trading rules during periods of market stress. Courts had repeatedly upheld exchange discretion in emergency situations. Proving manipulation requires demonstrating intent, she explained to a client. You'd need to show the rule changes were designed to benefit specific market participants rather than protect market integrity. Her client understood the problem. So, even if it looks like manipulation, proving it in court is nearly impossible. Meanwhile, a different question was emerging in procurement departments worldwide. If the paper market couldn't guarantee delivery and the physical market had 74% premiums, and Chinese supply was restricted and COMEX inventory was depleted, where was the silver actually going? Someone was accumulating. While manufacturers scrambled and investors panicked and regulators analyzed, physical metal was moving into vaults that weren't reporting publicly, into reserves that weren't registered with exchanges, into storage facilities in jurisdictions with strong privacy laws. A logistics coordinator at a Swiss storage company noticed the pattern: institutional clients, sovereign wealth funds, central banks from nations that didn't typically hold silver reserves, all requesting secure storage, all specifying no electronic reporting, all arranging private transport rather than using commercial bullion shipping networks. She mentioned it to her supervisor. He told her to process the requests and stop asking questions, because in certain businesses, curiosity is expensive. The institutional trap wasn't just about derivatives, it was about information asymmetry. Some players knew where the metal was, most didn't, and that gap was becoming weaponized. A policy advisor in Brussels received a classified memo on January 22nd that began with one sentence. Silver is no longer purely a commodity question. The memo outlined what intelligence analysts had pieced together over 3 weeks. China's export restriction wasn't reactive policy, it was coordinated strategy. December 22nd, silver announcement. December 18th, rare earth quotas reduced. December 29th, gallium export licenses suspended. January 4th, germanium shipping permits delayed. 4 critical technology metals, 4 separate announcements, 16 days. The pattern was deliberate, each metal essential for different sectors. Rare earths for electric motors, gallium for semiconductors, germanium for fiber optics, silver for everything. Individually, each restriction created supply stress. Together, they created strategic leverage. The advisor highlighted 3 sentences and forwarded the memo to the Minister of Economy. Because this wasn't about silver shortages, this was about technology supply chain control, and Europe had no countermove ready. In Washington, a similar conversation was happening behind closed doors. A Senate staffer pulled defense procurement data. The numbers were uncomfortable. U.S. military silver consumption, 41 million ounces annually. Missile guidance systems, radar arrays, communication satellites, naval destroyer components, domestic refined silver production, 8 million ounces. The gap was obvious. For 30 years, that gap hadn't mattered. Global markets were liquid, supply was reliable. Strategic stockpiles existed for genuine emergencies, but if China controlled 70% of refined supply, and export restrictions continued, and commercial manufacturers were competing for the same limited metal, defense procurement didn't automatically win, not unless someone made it policy. The staffer drafted a memo recommending immediate strategic reserve deployment and domestic refining capacity expansion. Estimated timeline for new refining facilities, 6 to 8 years. Estimated cost, $4.2 billion. The memo was dated January 21st. It was still sitting in an inbox. Meanwhile, investment demand was creating a secondary problem. A precious metals dealer in Dallas had sold more physical silver in January than the previous 6 months combined, not to industrial buyers, to individuals, retirees converting savings, business owners diversifying assets, investors who'd watched gold rise for 2 decades and believed silver was next. One customer bought 800 ounces, American Eagles, paid a $19 premium over spot price and didn't blink. The dealer asked why he was buying. I watched what happened when they printed trillions during COVID. I watched inflation destroy purchasing power. Now I'm watching industrial shortages drive real scarcity. This isn't speculation, this is insurance. He wasn't wrong. But he was competing with manufacturers who needed that same metal for production. Every ounce purchased by investors was an ounce unavailable for circuit boards. The collision between investment demand and industrial need was accelerating. A technology analyst in San Francisco published research on substitution timelines. Silver's electrical conductivity, highest of any element. Closest substitute, copper at 60% of silver's performance. For some applications, 60% was acceptable. Power cables, building wiring, low-frequency circuits. For others, it was catastrophic. High-frequency 5G antennas, precision medical sensors, satellite communication arrays, military radar systems. These applications required silver's exact properties: thermal conductivity, electrical resistance, corrosion stability. The research concluded that meaningful substitution across affected industries would require minimum 7 years of material science research, followed by 3 years of testing and regulatory approval, 10 years total. Silver shortage timeline, 6 to 18 months. The math didn't reconcile. An executive at a solar panel manufacturer made a decision on January 24th that would have been unthinkable 6 months earlier. They canceled expansion plans, not delayed, canceled. $52 million in committed capital, 2 new manufacturing facilities, 400 projected jobs, canceled, because input cost projections no longer supported the business case. At $85 per ounce silver, the panels were marginally profitable. At $120, they lost money on every unit sold. The executive explained it to the board simply. We can't price solar panels at levels where they compete with grid electricity if our primary input costs have doubled. The market doesn't care about our supply chain problems. They care about price per kilowatt hour. Green energy transition timelines just got longer, not because of technology failures, because of silver. A former COMEX trader turned analyst published a report titled The Unanswered Question. It asked something simple. If COMEX registered inventory is 28 million ounces, and open interest is 300 million ounces, and industrial consumption is 520 million ounces annually, and Chinese exports are restricted, where is the physical silver actually located? Not paper claims, not futures contracts, not derivative positions. Actual refined metal in verifiable, deliverable form. He estimated global above-ground refined silver inventory at approximately 2.1 billion ounces, but most of that was already in use, installed in electronics, embedded in solar panels, integrated into medical devices. Available refined inventory ready for industrial use? His estimate, 340 million ounces, against annual consumption of 520 million. The gap would close in 7 months. Then what? The report ended with one paragraph. The scramble we're witnessing isn't irrational panic. It's rational response to mathematical reality. Industries dependent on irreplaceable materials are securing supply before the gap closes completely. The question isn't whether silver reaches specific price targets. The question is whether industrial civilization's dependence on a single element, largely controlled by one nation, represents systemic vulnerability we've ignored for too long. 3 days after publication, the report had been downloaded 47,000 times. Policymakers were reading it. So were procurement managers, so were investors, and so were the people who already knew where the silver was, the ones who'd been accumulating for 18 months, while everyone else was just starting to ask questions.